Something remarkable just happened in the silver market. And if you're not paying attention, you may be missing one of the most significant signals we've seen in years. Over the past few days, silver has moved in ways that typically precede major market shifts. The kind of movement that demands your attention, not because of hype, not because of speculation, but because of what the data is telling us. This isn't about getting rich quick. This isn't about gambling on precious metals. This is about understanding a market signal that, historically, has preceded substantial changes in the broader financial landscape. I'm going to walk you through exactly what's happening, why it matters, and most importantly, what you should actually do about it. Whether you currently hold silver, whether you're considering entering the market, or whether you're simply trying to understand what this means for your broader financial strategy. By the end of this discussion, you'll understand the mechanics behind this movement. You'll recognize the patterns that experienced investors are watching. And you'll have a rational framework for making decisions, rather than reacting emotionally to headlines. Let's begin with what actually happened. Silver recently delivered what traders call a 10-day return event. This refers to a specific percentage gain over a compressed time frame that historically signals a shift in market structure. These events don't happen often. When they do, they tend to mark inflection points, moments where momentum shifts, where market participants begin repositioning, where the psychology of supply and demand changes fundamentally. But here's what you need to understand immediately. A sharp move up is not by itself a reason to act. Markets move, prices fluctuate. What matters is the context surrounding that movement. And the context right now is extraordinary. We're seeing this silver movement occur against a backdrop of unique macroeconomic conditions that haven't existed in combination for decades. Understanding these conditions is what separates informed decision-making from speculation. Let's step back and look at the larger picture. For the past several years, we've been living through an unprecedented period in monetary history. Central banks around the world have engaged in the most aggressive monetary expansion ever recorded. Interest rates were held at historic lows for over a decade. Then came a rapid tightening cycle that disrupted markets globally. Now, we're in a transition phase, a period where central banks are trying to navigate between controlling inflation and preventing economic contraction. This creates exactly the kind of uncertainty that historically drives investors toward tangible assets. Silver sits at a unique intersection. It's both an industrial metal and a monetary metal. It's used in solar panels, electronics, and electric vehicles. It's also held as a store of value and a hedge against currency debasement. This dual nature makes silver particularly sensitive to economic shifts. When industrial demand rises, prices respond. When monetary uncertainty increases, prices respond. When both happen simultaneously, we see the kind of movements we're witnessing now. Let's talk about history for a moment. Not to predict the future, but to understand patterns that tend to repeat. Silver has experienced several major bull markets in modern history. The 1970s run took silver from roughly $1.50 to over $50. The 2011 run took it from around $10 to nearly $50 again. These weren't random events. They occurred during specific macroeconomic conditions. In the 1970s, we had rising inflation, currency instability, and energy crises. In the late 2000s, we had financial system instability, quantitative easing, and negative real interest rates. What do we have now? Persistent inflation concerns, massive government debt levels, geopolitical instability, a global energy transition requiring massive amounts of industrial metals, central bank gold and silver accumulation at record levels. I'm not suggesting history will repeat exactly, but ignoring these parallels would be unwise. What's particularly interesting about the current setup is the supply side. Silver mining output has been relatively flat for years, yet industrial demand continues to grow, particularly from the solar and electric vehicle sectors. This creates what economists call a structural deficit. When demand consistently exceeds supply, prices eventually must adjust. The question isn't if, but when and how much. Let's focus on something concrete: industrial demand. Silver is the most electrically conductive, thermally conductive, and reflective metal on Earth. This makes it irreplaceable in many applications. Not preferable, irreplaceable. The average solar panel contains roughly 20 grams of silver. Global solar installations are growing exponentially. The International Energy Agency projects solar capacity to triple by 2030. Do the math. That's hundreds of millions of ounces of silver demand that didn't exist a decade ago. Electric vehicles use significantly more silver than traditional vehicles. The global EV fleet is expected to grow from roughly 30 million vehicles today to over 300 million by 2030. Again, this represents structural demand that compounds year after year. 5G infrastructure, medical devices, water purification systems. The list of industrial applications continues to expand. This isn't speculation. This is measurable, traceable, industrial consumption that creates permanent demand destruction. Once silver is used in these applications, it's effectively removed from the available supply. Now, let's discuss the monetary side. Central banks globally have been net buyers of precious metals for over a decade. Why? Because they understand what happens when you create trillions of currency units out of thin air. Individual investors are also increasing their precious metals allocations, not because they're pessimistic, but because they're realistic about monetary dynamics. When a government's debt to GDP ratio exceeds certain thresholds, there are limited options. You can raise taxes, which is politically difficult. You can cut spending, which is also politically difficult. Or you can inflate the currency, which reduces the real value of the debt. History shows us which option gets chosen most frequently. I'm not making a political statement. I'm describing mathematical reality. The numbers don't care about our opinions. Silver, like gold, serves as insurance against this dynamic, not because precious metals pay dividends or generate cash flow, but because they maintain purchasing power across time when currencies don't. Understanding where we are in the sentiment cycle is crucial for rational decision-making. Every market moves through predictable psychological phases: disbelief, hope, optimism, belief, thrill, euphoria, then the reverse: complacency, anxiety, denial, panic, capitulation, despair. Where is silver in this cycle right now? Based on multiple indicators, we appear to be transitioning from disbelief to hope. Precious metals have been unloved for years. Most retail investors exited the sector long ago. Mainstream financial media rarely discusses silver seriously. This is actually bullish. Major moves don't begin when everyone is excited. They begin when few people are paying attention. The recent sharp movement is starting to create awareness, but we're far from euphoria. We're far from the kind of excessive speculation that marks market tops. When your taxi driver is giving you silver price predictions, that's euphoria. When financial news networks are running special segments on silver multiple times per day, that's euphoria. When investment newsletters are guaranteeing returns, that's euphoria. We're not there, not even close. I'm going to discuss some technical analysis, but I'll keep it accessible. Silver recently broke through several key resistance levels. These are price points where selling pressure historically overwhelmed buying pressure. When prices break through these levels convincingly, it often signals a change in market structure. The breakout was accompanied by increasing volume. This is important. Volume confirms conviction. When prices rise on low volume, it's often temporary. When prices rise on high volume, it suggests genuine demand. Moving averages, which smooth out price action to reveal trends, are beginning to align positively. Short-term averages crossing above long-term averages create what technicians call golden crosses. These patterns don't guarantee future performance, but they do indicate momentum shift. Relative strength indicators show silver gaining strength against other asset classes. This is significant. It means silver isn't just rising because everything is rising, it's outperforming. For those who study these patterns, the current setup resembles the early stages of previous major moves. Not identical, but structurally similar. Let's zoom out to the macroeconomic level. Real interest rates, which are nominal rates minus inflation, remain historically low or negative in many countries. This environment is typically favorable for non-yielding assets like precious metals. Why? Because the opportunity cost of holding silver versus bonds is minimal when bonds are barely keeping pace with inflation. Government deficit spending continues at levels that would have been unthinkable 2 decades ago. This isn't sustainable indefinitely. Eventually, either growth accelerates dramatically to support the debt, or the debt gets inflated away. Both scenarios have implications for tangible assets. Geopolitical fragmentation is increasing. We're seeing a slow unwinding of the globalized system that dominated the post-Cold War era. This creates uncertainty. Uncertainty drives safe haven demand. The dollar's role as the global reserve currency, while still dominant, faces more challenges than at any time since World War II. Multiple countries are exploring alternatives for international trade settlement. I'm not predicting the dollar's demise. That would be premature. But I am pointing out that the monetary system is in transition, and transitions create volatility. If you already hold silver, this section is for you. First question, why did you buy silver in the first place? If your thesis was long-term monetary insurance and industrial demand growth, has anything changed? If not, a price spike doesn't necessarily mean you should sell. It means your thesis is playing out. However, we need to discuss position sizing and risk management. If silver has grown to represent more than your target allocation percentage, rebalancing makes sense. Not because you're bearish on silver, but because maintaining portfolio balance is fundamental discipline. For example, if you intended silver to represent 5% of your portfolio and price appreciation has pushed it to 8%, consider trimming back to your target. This forces you to sell strength, which is psychologically difficult but strategically sound. Set clear criteria for yourself. At what point would your original thesis be invalidated? What would need to change fundamentally for you to exit the position entirely? Write these criteria down. During euphoric markets, emotion overwhelms logic. Having predetermined rules keeps you grounded. Consider the difference between your core holding and trading positions. Your core holding is insurance. It's not meant to be traded actively. Your trading position, if you have one, can respond to short-term movements, but never confuse the two. The moment you start thinking of your insurance position as a trading vehicle, you've changed your relationship with risk. If you're considering entering the silver market, let's talk about how to do this intelligently. First, dispel any notion of perfect timing. You will not buy the absolute bottom. You will not sell the absolute top. Trying to achieve perfection is how investors miss opportunities entirely. The question isn't whether silver will go higher or lower tomorrow. The question is whether, based on your analysis of long-term fundamentals, an allocation makes strategic sense for your overall portfolio. If the answer is yes, then dollar-cost averaging is your friend. Rather than committing your entire intended allocation immediately, divide it into equal portions over time. If prices rise, you benefit from your initial purchases. If prices fall, you accumulate more ounces with your later purchases. This approach removes the pressure of timing perfection. It also smooths out your average cost basis. Consider the form of your investment carefully. Physical silver, mining stocks, ETFs, each has different risk-reward characteristics. Physical silver provides direct ownership and complete independence from counterparty risk. But it requires storage, insurance, and has wider bid-ask spreads. Mining stocks provide leverage to silver prices and can generate dividends, but they carry company-specific risks, operational risks, and don't always track silver prices perfectly. ETFs offer convenience and liquidity, but they're paper claims on silver, not direct ownership. You're introducing counterparty risk and management fees. There's no single right answer. The appropriate choice depends on your circumstances, goals, and risk tolerance. Let's talk about something fundamental that many investors ignore: position sizing. Your allocation to any single asset should be based on your total portfolio size, your risk tolerance, your time horizon, and your other holdings. For most investors, precious metals represent 5 to 15% of a diversified portfolio. Not 50%, not 80%, certainly not 100%. Why? Because silver is volatile. It can drop 30% in months. It can remain stagnant for years. If you're overallocated, these movements will cause emotional distress that leads to poor decisions. The paradox is this: the smaller your position, the easier it is to hold through volatility. The easier it is to hold, the more likely you are to actually realize the long-term benefits if your thesis proves correct. I've seen investors become so concentrated in precious metals that every daily price movement affects their emotional state. They check prices constantly. They read every article. They become consumed by short-term noise. This is the opposite of strategic investing. Size your position so you can be indifferent to short-term volatility. Size it so you can ignore the market for months at a time without anxiety. If you find yourself checking silver prices multiple times per day, your position is probably too large for your psychology. Risk management isn't about avoiding risk. It's about understanding and controlling it. Every investment carries risk. The goal is to ensure that any single risk doesn't destroy your financial stability. For precious metals specifically, consider these risks. Price volatility risk. Silver can experience dramatic swings. If you need liquidity during a drawdown, you might be forced to sell at a loss. Opportunity cost risk. Capital allocated to silver cannot be allocated elsewhere. If other assets significantly outperform, you've incurred an opportunity cost. Storage risk for physical holdings. Theft, loss, and damage are real possibilities requiring proper security measures. Counterparty risk for paper holdings. ETFs, mining stocks, and futures contracts all depend on third parties honoring their obligations. Regulatory risk. Government policies regarding precious metals can change, affecting taxation, ownership rights, or tradability. Understanding these risks allows you to mitigate them appropriately. Diversification mitigates concentration risk. Stop losses, while controversial in precious metals, can limit downside in trading positions. Proper storage solutions mitigate physical risks. But here's the most important risk management principle: never invest money you might need in the short term. If there's any chance you'll need to liquidate for living expenses, emergencies, or planned purchases within the next 2-3 years, that money should not be in volatile assets like silver. Let's address the elephant in the room: human psychology. More investors fail due to emotional decision-making than any other factor. Not lack of knowledge, not bad luck. Emotion. When prices rise rapidly, greed emerges. I should buy more. This is going to the moon. I need to maximize my position. When prices fall sharply, fear emerges. This was a mistake. I should sell before it gets worse. I need to preserve what's left. Both impulses destroy wealth. The antidote is process. Having clear, predetermined rules for how you'll respond to various scenarios. Write down your investment thesis. What specific conditions would invalidate it? What metrics are you watching? At what levels will you rebalance? During moments of emotional intensity, refer to this document. If nothing fundamental has changed, don't change your strategy. I cannot overstate this. Successful long-term investing is boring. It's checking your portfolio quarterly, not daily. It's rebalancing methodically, not trading frantically. If you find yourself excited about daily price movements, you're engaged in entertainment, not investing. The investors who build substantial wealth are the ones who can watch a 30% drawdown without panic, who can watch others make quick gains without envy, who can stick to their plan regardless of market noise. This isn't easy. It requires practice. It requires conscious effort. But it's the difference between achieving your financial goals and becoming another cautionary tale. I need to address something directly. Leveraged positions in precious metals, futures contracts, margin accounts, leveraged ETFs, option strategies. These instruments can amplify gains. They can also amplify losses catastrophically. Here's the brutal truth. Most retail investors who use leverage in commodity markets eventually blow up their accounts. Not some, most. Why? Because commodities are volatile, and leverage eliminates your ability to withstand normal volatility. Silver can easily move 5 and 10% in a day. If you're leveraged 5-1, a 10% adverse move represents a 50% loss on your capital. If you're leveraged 10-1, a 10% adverse move wipes you out completely. Even if your long-term thesis is correct, leverage can force liquidation before you're proven right. Professional traders use leverage, but they also use sophisticated risk management, have deep capital reserves, and can monitor positions constantly. You're competing against them. If you're working a full-time job, if you can't watch markets all day, if you don't have unlimited capital to meet margin calls, leverage is not your friend. The temptation is understandable. You want to maximize gains. You don't want to miss out on larger profits. But preservation of capital is paramount. You cannot compound returns if you've lost your capital. If you feel compelled to use leverage, ask yourself honestly, am I trying to get rich quickly? Am I trying to make up for past losses? Am I feeling desperate? If the answer to any of these is yes, step back. That's emotion, not strategy. Let me outline specific behavioral errors that destroy wealth in precious metals markets. Mistake 1, investing money you need for living expenses. This creates forced selling during downturns. Never put yourself in a position where market timing determines your financial survival. Mistake 2, buying because prices are rising. This is chasing momentum. The best time to build positions is when nobody cares, not when everyone's excited. Buying strength can work, but requires discipline to sell strength later. Mistake 3, selling in panic during corrections. If your long-term thesis remains intact, short-term price movements are noise. Corrections are normal. Expecting assets to rise in straight lines is unrealistic. Mistake 4, constantly trading in and out. Transaction costs accumulate. Taxes on short-term gains are significant. You miss the rebounds that follow sharp drops. Trading activity gives the illusion of control, but usually reduces returns. Mistake 5, ignoring portfolio balance. Letting winners run is good advice, but not at the expense of prudent diversification. Rebalancing feels wrong because you're selling what's working, but it's essential risk management. Mistake 6, believing in guaranteed outcomes. No one knows the future with certainty. Anyone promising specific price targets or time frames is either delusional or selling something. Maintain probabilistic thinking, not certainty. Mistake 7, comparing yourself to others. Someone else made more money faster? Irrelevant. Their risk tolerance, time frame, and circumstances differ from yours. Run your own race. Mistake 8, forgetting about taxes. In many jurisdictions, precious metals face specific tax treatments. Understanding this before investing prevents unpleasant surprises. Short-term capital gains can eat substantial portions of profits. Mistake 9, neglecting security for physical holdings. If you hold physical silver, proper storage isn't optional. Home safes, safety deposit boxes, or professional vault storage each have trade-offs, but doing nothing exposes you to unnecessary risk. Mistake 10, letting emotions override process. This encompasses everything we've discussed. Fear and greed are powerful. They will push you toward poor decisions if you let them. Process and discipline are your protection. So where do we go from here? The honest answer is, nobody knows with precision. But we can think probabilistically about different scenarios. Scenario 1, the industrial demand thesis plays out. Solar installations continue growing. EV adoption accelerates. The supply deficit widens. Prices gradually appreciate over years, with substantial volatility along the way. Scenario 2, a broader financial stress event occurs. Something in the system breaks, whether sovereign debt, banking sector issues, or currency instability. A flight to safety accelerates precious metals demand rapidly. Scenario 3, central banks successfully navigate a soft landing. Growth stabilizes, inflation moderates, and precious metals consolidate or correct as investors rotate to yield-generating assets. Scenario 4, some combination of the above, unfolding over different time frames and with varying intensity. Your strategy should be robust across multiple scenarios, not dependent on one specific outcome. This is why position sizing matters, why diversification matters, why emotional discipline matters. If scenario 1 unfolds, patient holders benefit over time. If scenario 2 occurs, having insurance allocation proves valuable. If scenario 3 happens, proper position sizing means you haven't sacrificed other opportunities. The goal isn't perfect prediction. The goal is preparation. Remember that silver is just one component of a comprehensive financial strategy. Your emergency fund, your income stability, your debt levels, your retirement planning, these fundamentals matter more than any single investment. Silver should not be your entire plan. It should be part of a diversified approach to wealth preservation and growth. Many investors make the mistake of becoming so focused on one asset class that they neglect everything else. They have perfect precious metal strategy, but inadequate emergency savings. Or they're allocated perfectly, but carrying high interest debt. Priorities matter. Handle the fundamentals first. Eliminate high interest debt. Build emergency reserves covering 6 to 12 months of expenses. Maximize tax-advantaged retirement accounts. Create stable income sources. Then, within that framework, precious metals can play their appropriate role. This might seem obvious, but I've encountered too many people who've invested in silver while neglecting basic financial health. Don't be that person. Let's get practical about implementation. If you're buying physical silver, understand the forms available. Coins like American Silver Eagles or Canadian Maple Leafs carry higher premiums but offer better liquidity. Bars typically have lower premiums but may have less liquidity and require more scrutiny when selling. Premiums above spot price vary with market conditions. During high demand periods, premiums can spike significantly. Factor this into your cost basis calculations. For storage, home safes provide accessibility but require security measures. Bank safety deposit boxes offer security but limited access hours. Professional vaulting services provide maximum security with varying levels of access. If you're investing through ETFs, understand the difference between physical-backed ETFs and synthetic exposure. Read the prospectus. Understand the fee structure. If you're considering mining stocks, treat them as equities first, precious metals plays second. Analyze the company fundamentals. Management quality, production costs, reserve life, and balance sheet health all matter. Junior miners carry more risk, but potentially more upside. Major producers offer more stability, but less leverage to metal prices. Diversification within the sector makes sense if you're allocating to miners. For most people, a combination approach often makes sense. Some physical holdings for true independence and insurance. Some exposure through more liquid vehicles for tactical flexibility. But again, the total allocation should align with your overall portfolio strategy and risk tolerance. Here's something rarely discussed in investment content: the value of patience. We live in an instant gratification culture. We expect immediate results. We check portfolio values constantly. We celebrate daily gains and despair over daily losses. This mindset is antithetical to wealth building. Substantial wealth accumulation takes time, not days, not months, years, often decades. The most successful investors I've studied share one characteristic: patience. They made their investment decisions based on sound reasoning. They sized positions appropriately. Then they had the discipline to do nothing for extended periods. Doing nothing is hard. It feels passive. It feels like you're missing opportunities. But excessive activity usually reduces returns. Trading costs accumulate. Taxes compound. You're constantly fighting your own psychology. The power of compounding requires time. The recognition of value by markets requires time. The validation of investment theses requires time. If you enter the silver market today, give your investment thesis time to play out. That means years, not months. I understand this isn't exciting. Nobody becomes a viral success story by exercising patience. But the goal isn't to entertain yourself or impress others. The goal is to achieve financial security and independence. And that goal favors patience every time. Let's be completely clear. If you invest in silver, you will experience volatility. There will be weeks when your position loses 15%. There will be months when nothing happens. There will be days when you question your decision. This is normal. This is expected. This is not a reason to change your strategy. Preparation is the key to handling volatility well. First, expect it. If you enter thinking the path will be smooth, reality will shock you. But if you expect substantial swings, you won't be surprised when they occur. Second, use volatility as a tool. If your thesis remains intact and prices drop significantly, that's an opportunity to add to positions, not abandon them. Volatility creates opportunities for those prepared to use it. Third, measure success appropriately. Don't evaluate your investment based on daily or weekly performance. That's noise. Evaluate based on longer time frames aligned with your original investment horizon. Fourth, maintain perspective. A 20% drawdown in a 5% portfolio allocation represents a 1% impact on your total wealth. Viewing it as a portfolio percentage rather than an absolute number reduces emotional impact. The investors who panic during volatility are usually those who overallocated, who invested money they might need, or who didn't truly understand their risk tolerance. If you've sized your position properly and invested only long-term capital, volatility becomes manageable. Uncomfortable, perhaps, but manageable. Everything we've discussed comes down to strategic versus tactical thinking. Tactical thinking focuses on short-term price movements. What will happen this week? Should I buy today or wait until tomorrow? What's the immediate catalyst? Strategic thinking focuses on long-term positioning. Given the macro environment, does this asset class deserve allocation? How does it fit my overall portfolio? What role does it serve? Both have their place, but strategic thinking drives long-term success. The traders who focus tactically might catch some short-term moves. They might even make impressive returns in isolated timeframes. But the wealth builders I've observed across decades are strategic thinkers. They identify long-term trends. They position accordingly. They have the discipline to ignore short-term noise. You need to decide which type of investor you want to be. If you want to trade actively, understand that you're competing against professionals with better technology, more information, and deeper pockets. It's possible to succeed, but it requires significant time, skill, and emotional control. If you want to build wealth strategically, the requirements are different. Education, patience, discipline, and consistent execution of a sound plan. Most people are better suited to the strategic approach. It requires less time, creates less stress, and historically produces better outcomes for most investors. Be honest with yourself about which path aligns with your personality, skills, and circumstances. Regardless of where silver prices go from here, your discipline must remain constant. If prices continue rising, resist the urge to abandon your position sizing rules. Resist the temptation to over-allocate because it's working. Rebalance according to your plan. If prices consolidate or correct, resist panic. Revisit your original thesis. If it remains valid, drawdowns are simply part of the process. Use them strategically if appropriate. If nothing happens for months, resist boredom-driven trading. Not every day needs excitement. Sometimes the best action is no action. The market will constantly tempt you to abandon your discipline. Dramatic movements create emotional responses. Our brains are wired to respond to volatility with action. But successful investing often means fighting these instincts. Create systems that support discipline. Automate what can be automated, remove friction from good decisions, and add friction to bad ones. If you tend to panic sell during drawdowns, make selling require several steps. Give yourself cooling off periods. The tools that support discipline differ by person. Some need detailed spreadsheets, others need minimal portfolio checking. Some benefit from accountability partners. Others work better alone. Find what works for you, then implement it ruthlessly. We began by discussing a significant signal in the silver market. Let's come back to that. Signals matter. They provide information. They indicate potential shifts in market structure. But signals are not certainties. They're not guarantees. They're data points that inform decision-making. The signal we're seeing now suggests something is changing. Industrial demand is real. Supply constraints are real. Monetary uncertainty is real. These factors create a backdrop where silver could perform well over time. But could perform well is different from will definitely appreciate X% by date Y. The distinction is crucial. Invest based on probability and reason, not certainty and emotion. Position yourself to benefit if the thesis plays out, but protect yourself if it doesn't. This is how rational investors approach markets, not with guaranteed outcomes, but with calculated positioning based on available evidence. We've covered substantial ground: market signals, historical patterns, industrial and monetary demand, investor psychology, risk management, practical implementation. Now you need to decide what this means for you personally. Do you have exposure to precious metals currently? If not, does the case we've discussed suggest it deserves consideration within your overall strategy? If you do have exposure, are you positioned appropriately? Is your allocation aligned with your risk tolerance and portfolio balance? Are there adjustments needed to align your current holdings with strategic thinking? These are personal questions. I can't answer them for you. Your circumstances, goals, and risk tolerance are unique. But I can tell you this. The investors who succeed long-term are those who think independently, act deliberately, and maintain discipline through all market conditions. They don't follow the herd. They don't react emotionally. They don't expect perfection. They educate themselves. They make reasoned decisions. They execute patiently. They adjust when necessary, but don't overtrade. This approach won't make you rich overnight. It won't provide exciting stories at dinner parties. It won't satisfy the human desire for drama and immediate gratification. But it works, across time, across markets, across different economic environments. The choice is yours. You can chase excitement and short-term gains, or you can pursue strategic wealth building. One path is crowded with people who never achieve their financial goals. The other is traveled by those who systematically build security and independence. The alert we're seeing in the silver market is real. It's significant. It deserves attention. But attention doesn't mean abandoning discipline. It doesn't mean emotional decision making. It doesn't mean gambling your financial future. It means incorporating new information into your existing framework. It means evaluating whether adjustments to your strategy make sense. Whatever you decide, do it deliberately, with full understanding of both potential benefits and risks. Remember that no single investment determines your financial future. Your habits, discipline, and long-term strategic thinking matter more than any individual position. Silver might be entering a significant period. It might not. The future remains uncertain. But your approach to navigating that uncertainty doesn't have to be. Build your strategy on sound principles. Size positions appropriately, manage risk diligently, exercise patience consistently. Do this, and you'll be prepared for whatever the market brings. Not because you predicted it perfectly, but because you positioned yourself to handle multiple outcomes. That's the mark of sophisticated investing. That's how wealth is built and preserved. The opportunity is there for those willing to think clearly and act rationally. The question is, are you one of them? Thank you for your time and attention. Use this information wisely. Invest carefully. Stay disciplined. Your financial future depends not on market predictions, but on your consistent execution of sound principles. Go forward with confidence, but also with caution. With optimism, but also with realism. And above all, with the discipline that separates successful investors from everyone else.